What about commodities? Let's see what the trade war, what the impact on that sector is. Energy, gold. Gold fell slightly last week on the potential rollback of some tariffs between the U.S. and China. Joining us now, Daan Struyven, co-head of global commodities research at Goldman Sachs. Is there anything that you can say in general about growth-related commodities signaling that there is a looming slowdown in global growth?
So I think you want to distinguish between what you see in price and what you see in demand. In the spot demand data, both for oil and copper, the actual spot demand data still looks solid, consistent with the hard economic activity data, for instance, in the US or China, that still looks solid. However, if you look at prices, we have seen, following the April 2nd tariff announcement, a pretty large sell-off, both, for instance, in oil and copper, which are commodities that tend to be positively correlated with GDP growth. But we have seen a bit of a rebound, a bit of a growth relief trade that we are seeing in the commodities, but also in risk assets.
It's counterintuitive to think that demand can remain the same and prices can weaken. How does that happen? I mean, I could see if supply went up, but that hasn't happened, has it?
So in the case of both copper and oil, I think it's expectations of weaker demand that have weighed on price.
We haven't seen it yet.
We haven't seen it yet.
Should we believe the price or should we believe the demand? We should believe the price.
We incorporate the view from our economists that global growth will weaken, with U.S. growth this year on a Q4 basis of 0.5%, global growth this year of 1.4%, not a recession, but a weakening. And I think that following the relief rally, both risk assets and commodities are not pricing a lot of upside here and are underpricing recession risk. And then to your supply point, on the oil side, we are seeing, despite sharp downgrades to our U.S. shale supply outlook, we're seeing pretty solid supply, both from OPEC Plus, which is set to increase production in May by a pretty large 0.4 MBD amount, and then also solid supply growth from ex-OPEC, ex-US countries, like Brazil, like Guyana, like Canada.
Is anyone shutting down production in the United States at prices where we are right now?
We think that the current price level is becoming a critical price point for the higher marginal cost producers. The current TI price level of close to $60 per barrel is roughly percentile 75 in the distribution of break-evens, meaning that about a quarter of the US producers is no longer meeting their 15% hurdle rate. And that's why we have downgraded our U.S. shale supply outlook.
So it's not, it is unprofitable for some producers at this point, or not as profitable as it needs.
Yes, and we have seen some early signals from Q1 earnings, some early signals from the drop in the oil rig count that U.S. shale supply growth after years of strong growth will probably edge down slightly.
Do you consider currencies to be commodities?
I do think that currencies are pretty important for the commodity price outlook. The most noticeable fact here is that if we were to see further dollar depreciation, if investors globally who have been very overweight U.S. assets after a decade of exceptional returns, if they were to move only a little bit of their, for instance, U.S. fixed income allocations to gold, it would probably mean the next giant leap for gold prices, even if it's only a small step for the U.S. fixed income market. Why? Because the gold market is about 100 times smaller than the U.S. fixed income market. So a small move for non-gold markets may be the next big move for gold prices.
When you see, like, you think of a weak dollar, it would cost more to buy oil, it would cost more to buy gold. Why are they diverging?
So we think that the weaker dollar that we have started to see and that our FX strategists expect to continue, that weaker dollar is primarily beneficial to gold prices, but should also benefit the demand outside of the U.S. for dollar-denominated commodities such as copper, where the U.S. is only a small part of global demand, but where Asia and Europe, who pay those commodities in dollars, dominate the global demand.
So if there was some shift from U.S. fixed income to gold, it would benefit gold immensely, but would you notice it in fixed income? Would you notice it in the 10-year?
Depends on the magnitudes.
Well, you said it only takes a very small amount to move
yes,
gold.
It would be much more noticeable in the gold market than in the fixed income market in the U.S., which is much bigger. But I do think that some of the unusual correlations we have seen over the last 2 weeks, dollar down, risk assets down, but U.S. yields up, that is consistent with a desire from some investors to rebalance their allocations from a very large U.S. overweight to a more neutral.
Okay, so how about copper? What is copper? Obviously, it's always supply and demand related, but supply's been a big deal for copper when we don't build anything new in many, many years or develop it. What's moving it now, and where is it?
So the long-term supply picture for copper still looks quite tight. We have pushed out our forecast for a deficit in the copper market from 25 to 26 because we incorporated weaker global growth. But the long-term supply picture still looks tight. And by mid next year, we think that the copper price should recover to roughly $10,500 per ton. That's exactly the level that you need to incentivize the Chilean miners to keep investing. And we think that flat Chile mining supply after years of low investment is needed to meet growing demand, and demand will grow, we think, because of structural electrification trends, even if global growth slows down.